In this video, traders, we're going to look at why do hedge funds blow up. Stay tuned. Hey guys, warm welcome to you. Okay, so this is interesting to me because recently, and when I do this, by the time I've done this video, when you see it's uploaded, there is a hedge fund or supposed hedge fund, it really is managing money, about 100 million, 75 to 100 million, who blew up trading natural gas. And then when I talk about a blow up, I mean literally wiped out all the money, which is a very good point to distinguish between two types of blow up. Now, a blow up in this example here, what I'm talking about, is someone who wipes out the whole lot and is just a catastrophe. But some people will also say a blow up as to a company that goes bust. Now, that could be, a hedge fund is actually ultimately a company, right? They're managing money, they're getting fees, they're getting management fees with normally a 2 and 20, they get 2% management fee, they get 20% on performance. Done a separate video on that and how they structure all that kind of stuff. But as a pure business, they may well just be not performing. So they might not be performing, so they might be getting performance fees. The management fees might be dropping off because people are withdrawing the money, you get redemptions, all this kind of stuff. And so the assets under management are decreasing. The company's not viable to operate anymore. The company goes bust. It returns the money to investors. Now that's not blowing up. Maybe they get back less than they put in, obviously depending on when they invested. Maybe they invested over a 10 years period. First 8 years were great, last 2 weren't so good, so they're up on the deal. But you get the point. That could still be considered a blow up because the company's gone bust. But let's look at the other side. Why do, and that side, why do hedge funds blow up? That's just commercial, isn't it? If they can't perform, they're not doing it like any other business. You're a restaurant owner, you're not getting people through the door, you can't cover your bills, you have to close the doors. Same kind of thing. If you're not performing in the markets, you're not giving people what they want. Restaurant is food. In a hedge fund, it's return on their capital. You're eventually going to go bust if they don't trust you enough to stick with you for longer term, which is why the kind of bigger guys can weather those storms. Anyway, digressing slightly, let's look at reason, or kind of work out between us, what's the reason that hedge funds blow up. Now, it's not like a simple question. We can't just go in there and go, well, here's the answer. There's a lot of things at play. And if you look at some of the bigger funds that have gone like long-term capital, they only lost 4.6 billion. I say only because they had to be bailed out and it was a bit of a whole disaster. And there's a video on that if you want to go and check it out. We talk about that. And we talk about Amaranth as well, where they lost 6 billion. But the kind of thing that, the common theme with just a couple of these, and like I said, go and check out a video if you want to see some of the bigger ones and go into more detail, but this is more the reason as to why, and maybe we can learn some lessons from this as our traders ourselves. To me, it seems the reason is one thing: it's over leveraged in a position. And you know what? That's why most retail traders blow up as well, right? They're chugging along, they've got a $10,000 account, they're trading at a very small size, all of a sudden they start to go bigger size, they can't stomach, they can't weather the storm of loss of the strategy not performing, bang, they're out of the game. That's exactly what seems to happen to these guys. When you dig into it and you kind of look, and of course there's a lot of secrecy and smoke and mirrors around this kind of stuff, but ultimately it's because they're in positions that are too big for really the size of the assets under management, because they want to. The trouble you've got with hedge funds, and this is not hedge fund bashing at all, guys, you know, obviously we're all into making money from the markets here, so we're not bashing anyone who's doing that at all, but the model is slightly skewed in that you're using other people's capital as risk and you're getting paid on performance. Now, the better hedge funds have their own net worth in the fund, so they might say, listen, my net worth is 10 million, I've got 6 million of that in the fund, so I've got a lot of skin in the game, and that is way more enticing to investors. They like to see that investors have got hedge fund, it's got skin in their own hedge fund, which makes it slightly differently. But if they haven't, you can see there's perhaps a conflict of interest. Anyway, we're going off track. Let's get back onto the point of this. Why are they blowing up? They are over leveraging in positions they can't get out of. That's generally what happens. They're stuck in something that's illiquid. They're stuck in something that they've built a big position in, and then when it starts going against them, it takes too long to unwind, and by the time they unwind it, they get caught out and they're in a massive loss. They're in a position where the risk is they haven't seen something coming. So there was that Porsche example, the Volkswagen example, where Porsche were going to buy out Volkswagen. If I've done a separate video on that, go and check it out. Porsche, we're going to buy a Volkswagen. The Volkswagen share just ripped, and there's loads of reasons why, and exactly that kind of thing. The hedge funds who were short on that were just stuck in it because it was an unusual event that came out of nowhere. You could consider some of these spikes in some of the commodities as well. If they're selling options, call options, you get these spikes out of nowhere. They're kind of stuck in the trade because they've got so much size on, they can't unwind it. You have, and because they're, over leveraged on that specific strategy, that's what kills them, and that's the point. Now, it's not size per se. You've got funds out there that are managing massive amounts of money, and you hear them getting hammered on one position. One that springs to mind is going to be Bill Ackman with Herbalife. Hammered on the position, and there's a couple of others he's been hammered on, absolutely hammered in terms of monetary loss. But because this fund is so big, he's not going to put 80% of the fund in one idea, even if he was so convinced about the idea and it turned out not to be right. Yes, it's damaged him. Yes, it's set him back a while, but it's not out. He's not going to not repair that. Eventually, you would expect that will come back. That's the difference. The funds that are piling all their assets into one bet, one big deal, and then it works for them, it works for them, it works for them. Then when it doesn't, that's when they're out of the game. So what lessons can we learn from that? The biggest thing why hedge funds blow up is that they're over leveraged and they aren't managing the risk. So for us, yes, we're not managing billions, but whatever we're managing, we need to be prudent that we are trading the size that is suitable for our account, and we're trading in a way that caps the risk. If we are trading more size, we know that we can get out of the deal if it goes sour. If it doesn't work for us, are we stuck in it? Are we going to be stuck in something that could kill us? Like if we're selling call options, like if we're buying a stock that could get halted for news, it's a small cap stock. All those kind of things. Those are the hidden risk in things we need to be aware of to avoid blow up. And if even the big boys do it, then definitely us as retail guys are vulnerable to it as well. So keep an eye on that, keep an eye on the risk, keep an eye on some of the position sizes, all those kind of stuff, and you'll save yourself from a blow up. Take care. Bye-bye.